Welcome to the deep dive. Today, we're getting into something that affects so many of us, success in trading and investing.
That's right.
We've gone through a huge stack of sources from, real market veterans, and our mission today is to pull out the brutal truth of what actually works.
And here's the thing. The answer is probably not what you're expecting.
Right. It's very counterintuitive.
It is.
Right.
I mean, most people start out asking the same two questions. What should I buy right now? Or maybe, what's the market going to do next week?
The crystal ball questions.
Exactly. And our sources just overwhelmingly confirm that those are the wrong questions. They put all your energy into prediction, and that's a losing game.
So we're not talking about prediction today. Instead, we're unpacking what really matters, the psychological and structural parts. We're going to cover 4 big ideas.
Yep. We'll start with self-mastery, then get into the psychological traps we all fall for.
And after that, how to actually define success using a concept called expectancy. And finally, what might be the single most important factor of all? Position sizing.
That one's the real game changer.
It really is.
Yeah.
So let's start at the beginning. If the secret isn't some magic stock tip, then what is it? Our sources keep using this term, the Holy Grail. What are they talking about?
Well, they're all pretty much unanimous on this. The holy grail of trading isn't something external you can find. It's internal control. It's self-mastery.
Self-mastery. Okay.
Yeah. The argument is that until you've mastered yourself, your greed, your fear, your reactions, you're always going to be fighting the market. And you'll probably lose, no matter what system you're using.
That can sound a little abstract, though, a bit zen. How does that actually work for someone listening in their own trading?
It connects directly to your emotions. There's this great metaphor they use. Life starts out neutral. That's the grail.
Okay.
But then as we develop self-awareness, fear and greed pop up. The great traders, they're the ones who get rid of the greed and the fear that comes with it. They get back to that neutral state.
So it puts all the responsibility right back on the individual.
Absolutely. The core belief you have to have is this. The market doesn't create victims. People turn themselves into victims with their own undisciplined actions. It's all on you.
Which is a tough pill to swallow.
Yeah.
But it also means you have control.
That's the empowering part. You control your own destiny.
Okay, so if we know that we're the ones in control, why does everyone, and I mean everyone, spend 95% of their time focusing on the entry? When to get in?
Because we're hardwired to. It's this massive psychological trap that the sources call the lotto bias.
The lotto bias. I like that.
Yeah. We fundamentally want to control the market. And the only place it feels like we can do that is by perfecting our timing. Our entry, we're trying to force the market to do what we want.
And the whole industry just feeds that desire, doesn't it?
Oh, completely. Just go look at the books on investing. They're packed with these strategies promising 80% reliable entries. They show you these perfect, idealized charts.
Selling the dream.
Exactly. Selling the dream that you can win the lottery. But the actual golden rule of trading isn't about entry at all. It's created by how you get out of the market, your exits.
The conference anecdote in the source material really drives this home.
It's so stark. So there's a speaker giving a talk on high probability entry signals. The room is packed. Hundreds of people. He sold out of all his books.
Of course.
At that same conference, another expert is talking about money management, the actual key factor for profit. And maybe 30 people showed up.
30? Wow.
People just gravitate towards the things that don't really work because they offer this illusion of control.
And that illusion is also fueled by these other cognitive biases, right? Like the law of small numbers.
Yes. That's when you see a pattern in like 2 or 3 examples and think you've cracked the code.
Right. You see a stock do some little 4-day dance and then jump, and suddenly that dance is your new guaranteed buy signal.
And your brain just clings to it, even if it fails the next 10 times.
Yeah.
Then there's the need to understand bias.
The media's favorite one.
Totally. We hate randomness. It makes us uncomfortable. So we invent these elaborate stories to explain why the market went up or down.
The market fell today because of inflation fears in Borneo.
Right. Or traders get deep into things like Elliott wave theory, trying to find this perfect mathematical order in what is honestly often just noise.
And all that focus on the why distracts us from the how we manage our own system.
That's the perfect way to put it.
So if we stop focusing on the unreliable why, we need a better way to measure success, an objective way. And that brings us to expectancy.
This is where it gets really fascinating. Because what you find is that expectancy and your probability of winning, they are not the same thing. Not at all.
Okay, break that down for us.
Well, people love high reliability systems. They want to be right a lot. But those systems often have these huge, devastating losses that wipe out all the small wins.
Leading to a negative expectancy overall.
Precisely. The sources have this great marble analogy. Imagine two games you can play. Game one give you a 60% chance of winning. Sounds pretty good, right? But the payouts are small, and the losses are big enough that your expectancy is only 20 cents for every dollar you risk.
20 cents.
Now, game two. In this game, you only have a 36% chance of winning. You lose way more often than you win.
Doesn't sound great so far.
But, and this is the key, your winners are so much larger than your losers that this system generates a 78-cent expectancy for every dollar you risk.
Wait, hold on. The game where I'm wrong most of the time is almost 4 times more profitable.
Exactly. And that forces you to totally rethink what a good system even means. You have to focus on maximizing your reward-to-risk ratio. And the way to think about that is with the R multiple concept.
Let's define the R multiple.
R is simply your initial risk. So if you get into a trade and you set a stop loss where you could lose $500, that $500 is 1 R.
Okay, simple enough.
Now, if that trade ends up making you $5,000, you've just made a 10R profit. The goal is to hunt for those big R multiple trades, 10R, 20R, or even bigger.
That reframes everything.
Hmm.
Suddenly, having a bunch of small 1R losses doesn't feel so bad because you know you just need one big winner to make it all worthwhile.
That's it. One 10R winner makes 7 or 8 small losses totally irrelevant. You're not trading to be right. You're trading to get paid.
Okay, so if self-mastery is the foundation and expectancy is our goal, then position sizing. That's the engine. And the sources say this is more important than entry and exit combined.
It is. It's astounding. It changes everything because successful systems all rely on something called anti-martingale strategies.
Anti-martingale, meaning you increase your position size when you're winning, not when you're losing.
Exactly. The classic martingale strategy is what amateurs do. They lose, so they double down, hoping to win it all back.
And that leads to ruin.
Inevitably, you run out of money. Anti-martingale is the complete opposite. You leverage your gains, you press your bets when your system is working.
This leads us to what I think was the most shocking part of the research. The thing that just invalidates the entire focus on entry. The random entry system.
It's an absolute bombshell. Researchers tested a system with a totally random entry.
Random, you mean like flipping a coin?
Literally a coin flip for when to buy. They paired that with a simple trailing stop for the exit and a strict 1% risk algorithm for position sizing.
And what happened?
It made money, consistently. In fact, over all the simulations they ran, when you included proper position sizing, the system had a 100% success rate at generating a positive return.
A 100% success rate with a random entry.
Yeah.
That just proves it. The edge isn't in the entry, it's in the risk management and the sizing.
That's where the edge is. It's all mathematical. The entry is, statistically speaking, almost noise. And the sources suggest a couple of good sizing models.
What are they?
For a long-term trend follower, they recommend the percent risk model. You just decide to risk a constant percentage of your equity, say 1%, on every single trade.
So your risk grows as your capital grows.
Right. For more active traders who might use tighter stops, the percent volatility model is better. This one adjusts your position size based on how choppy the market is.
So if things get wild, your positions automatically get smaller to manage that risk.
You got it. It's how you engineer your growth curve and protect your capital.
So this whole deep dive really flips the script. Success is about psychological control. Focusing on positive expectancy, not just your win rate, and then using disciplined position sizing. It's a total reversal of how most people see the market.
It is. And the final test, the real mark of a professional, is planning for every possible contingency. I mean, you have to mentally rehearse for a catastrophe.
You need a plan for the thing you can't even imagine.
Exactly. You need to ask yourself the extreme question from the sources. What happens to my system if a meteor lands in the Atlantic and wipes out half the population of Europe and the United States?
That is extreme question.
It is, but that's the level of preparedness you need. If your plan can survive that, then you've actually built something robust enough to achieve real, sustainable financial freedom